It's been said that if all the money in the world were distributed equally among all the people in the world, within 10 years' time, 97% of all the money would be under the control of 3% of the people. Why? Banking. Those who understand the banking equation capture and control the money. Most people think they understand banking. They write checks, put money into the savings, and get loans at the best interest rate they can find. But they fail to understand the most important part, and as a result, the average consumer pays over 34% of their after-tax dollars on interest over their lifetime. Think about that. They willingly give away over 34% of all their after-tax dollars in interest. That's banking. It's great if you're on the right side of the equation. Most aren't. Most people focus on two things when they buy something: price and interest rate. Look at the results of this approach. 25% of every dollar spent on car payments goes toward interest, even with a car loan at 8.5% APR. Over 86% of the average American's mortgage payments go toward financing, even at 7% fixed APR. As you can tell, the volume of interest is the real issue, not the annual percentage rate. It's like going to the doctor's office to get a shot of some kind. It's not the rate at which the medicine is injected into you, it's the volume. Too little and it won't do any good. Too much and it can kill you. The truth is that price and interest rate are not the reasons why Americans waste over 34% of their income in interest. It's the banking equation that's the problem. You're about to learn how you can pay yourself the 34.5% interest that you are currently paying to banks and financial institutions. That change will have a dramatic financial impact for you in just a few short years. In fact, it could amount to over $1 million on your next 11 car purchases alone. The first principle you must understand is that you finance everything you buy. You either pay interest to someone else or you give up interest you could have earned otherwise, which is called opportunity cost. As mentioned earlier, the average American spends 34.5% of all of their after-tax income on interest for their mortgages, car loans, and credit cards, and saves less than 5%. Yet all financial discussions focus on getting a higher return on the 5% of savings, completely ignoring the 34.5% spent on interest. What a tragedy! That's like making $100,000 per year in after-tax income, spending $34,500 on interest, and saving $5,000. You would have to get a 690% return on your $5,000 in savings to make up for the $34,500 spent on interest. Do you know anyone getting a 690% return on their savings each year? The real problem is the $34,500 being spent on interest. It's not practical to think you can make it up by getting a higher return on the $5,000 in savings. That's like flying an airplane that's only capable of flying 100 miles per hour right into a 345 mile per hour headwind. No matter how hard you try, you're moving backwards at 245 miles per hour. You'd be better off to land your plane and wait until the wind changes direction. Eventually, you'll get a nice tailwind of 345 miles per hour. Then, your 100 mile per hour plane will be moving at a ground speed of 445 miles per hour. Now, we all know that in the airplane world, you can't control the environment in which you fly. However, in the financial world, thanks to the infinite banking concept, you can, by becoming your own banker. This will allow you to recapture all of the interest you're currently giving to banks, credit card companies, and other finance companies, so you can literally pay yourself all of the money that you are currently paying out in interest and other financing costs. So in our example, instead of paying banks $34,500 per year in interest, you can pay yourself $34,500 per year in interest, which amounts to $69,000 more per year, not including the $5,000 you're already saving. Becoming your own banker does not require getting a bank charter from the bank commissioner or a building or anything like that. The simplest way to becoming your own banker is to use a mechanism that has been around for over 200 years called participating, dividend-paying whole life insurance, known as permanent insurance, which is very different than term insurance. Term insurance is the equivalent to renting coverage for a specified period of time or a specific term. and pays the beneficiary a promised face amount as a death benefit if the insured person dies during the term. If not, the cost of the insurance increases since the insured person is now closer to death. This continues to happen until at some point it is simply cost prohibitive to continue with term coverage, so the coverage is typically dropped. Permanent life insurance, on the other hand, insures a person for life. The insurance company hires actuaries and rate makers to estimate how much money must be collected in order to pay the eventual death benefit, yet still make the profit they desire. In order to determine this, they estimate how much money they will earn through investing the premium payments, how much it will cost them to manage the investments, the time period over which premiums will be paid, and the life expectancy of the insured person. Finally, to determine the amount of the premium payments, they must know how often and over what time period the premiums will be paid, which is known as the payment period. Shorter payment periods have higher premiums because they are effectively paying in advance for the cost of insurance. The shorter the payment period, the better suited it is for the purposes of the infinite banking concept. To understand why, let's break down a typical premium payment. Assume the actuaries and rate makers determined you would have to pay $20 to the insurance company for them to be able to run their company, make their desired profit, and be able to pay your beneficiaries the death benefit upon your passing. If $20 is their best estimate, they're going to charge you $25 to build in a little margin for error. Let's say you decided to shorten the payment period, so your actual premium was $50. A little bit of that, say 50 cents, will be spent by the insurance company to pay their employees who run the company. The insurance company will invest the remaining amount into bonds, mortgages, real estate developments, or joint ventures with other private organizations, unless the owner of the policy exercises their contractual right to use the money elsewhere. That is the key to becoming your own banker. Every life insurance policy, which is a contract, plainly states that the owner of the policy, who is the person that pays the premiums, outranks every potential borrower in access to the money that must be lent. So what does this mean? This means that the owner has absolute control over the investment function of the company. The insurance company can only invest the money if the owner of the policy does not exercise his option to use the money instead. So what can the owner use this money for? Anything he wants. Now listen closely, because you are about to see the power of becoming your own banker. Remember that 8.5% car loan that ultimately cost you 25%? Instead of buying that car today, if you fund your bank for the next 4 years by making premium payments into your permanent life insurance policy, you will be able to borrow from your own bank, which is the cash value in your policy, to pay for the car. Then, instead of making payments to the automotive financial company, you make the payments to yourself by making the payments back into your policy. To maximize the power of becoming your own banker, you must pay yourself at least the amount of interest you would be charged by the automotive finance company, preferably more. What does this amount to? Let's assume you'll buy a new car every 4 years for the next 44 years, so 11 cars total. Each car will be financed for $10,550 and can be financed at 8.5% interest for 48 months. You have a choice with how to pay for these cars. You can use one of 5 methods. You can buy them through a bank or other finance company, lease them, pay cash for them, use an interest-earning savings account, or use your own bank by using the infinite banking system. Let's look at each method in further detail. Buying the car through a bank at 8.5% interest would cost $260 per month, which is $3,030 per year. Over 44 years, that amounts to $137,280. Leasing a car costs a little bit more. Why? Because you lease from the owner of the car. Is the owner a fool? No. He will make some money on the activity. Let's then assume that leasing will cost you $175,000. Paying cash for the cars will first require you to save up for the car, so you would have to defer buying the first car for 4 years. The overall cost for the cars would be $116,050, which is the $10,550 times 11 cars. The last 2 methods both involve having a banking mentality. The difference is using your own bank versus using someone else's. Let's compare. Assume that for the last two methods, you understand the need to capitalize your bank, so you accumulate $5,000 per year for 7 years before purchasing the first car. You could accumulate your money in a savings account and buy certificates of deposit at someone else's bank in the amount of $5,000 with a yield of 5.5% interest. However, this interest is taxable, so the after-tax effect is 4%, assuming a 30% tax bracket. After 7 years, you would have $41,071 in your account. So you buy your first car and continue making the $3,030 car payments into your savings account. By year 50, you would have $258,927 in this account. Alternatively, you could accumulate your money in a dividend-paying permanent life insurance policy instead of at someone else's bank. For the first 14 years, putting your money in someone else's bank comes out ahead. But from that point forward, the infinite banking concept is favored in an accelerating fashion. In fact, by year 50, you will have $964,638. That's $705,710 more than putting your money in someone else's bank. Why is this? Because when you become your own banker, you are the only owner of your bank, so you receive the profits that would otherwise go to the bank. It's that simple and that powerful. There really is no comparison. Plus, by using a dividend-paying permanent life insurance policy as your bank, you get the other inherent benefits with life insurance policies. Namely, the dividends paid on a life insurance policy are not taxable. The money you borrow from the cash value is not taxable. And the cash value is protected from creditors and judgments in most states. Right now, you're probably asking yourself, why haven't I heard about this earlier? Well, that's a good question. Maybe it's time you worked with an advisor who is an expert on this approach. Introducing Gerald Kloppe with Nation's First Financial, the subject specialist on the infinite banking concept. Gerald can help you become your own banker. He will show you exactly how to most effectively structure your own bank. He'll further show you which life insurance companies and policies work best with the infinite banking concept, the maximum amount of premium you can pay to fund your bank without it becoming classified as a modified endowment contract and losing the inherent tax advantages, how to structure a system of policies to optimize your bank, and how to borrow from your policy tax-free during your retirement. Gerald will use the powerful software available to demonstrate exactly how this will benefit you. In fact, when you schedule an appointment for a free consultation with Gerald, he will tell you how you can get a copy of the book Becoming Your Own Banker by R. Nelson Nash, the founder of the Infinite Banking Concept. Call Gerald today. You can't afford not to.